Markets have obviously endured a bit of a roller coaster ride recently, although our performance has been reasonable. We generally declined a bit less as markets fell in April, but haven't bounced quite as much as they recovered throughout the latter half of the month and May. As markets plummeted in the immediate aftermath of President Trump's Liberation Day tariffs, our broad underweight to the US and specifically the Magnificent Seven group of mega cap technology stocks was a bit of a positive for our portfolios. Also, our overweight to areas that were more resilient, such as the UK, as well as defensive short duration debt, were also good overall contributors. Although this was offset somewhat by our overweight to US small and mid-sized companies, which overall was a bit of a drag on portfolio performance. However, we have been happy with the performance of our portfolios given the degree of volatility that has been prevalent in markets recently. We continue to see potential risks within the fixed income market, both in the US and the UK, and as such we remain broadly defensive. Whilst each nation is facing slightly different concerns regarding their fiscal position, their debt price does remain correlated. So there is limited opportunity to take advantage of relative price movements between the two. However, we have noted that yields on sovereign debt in both the UK and the US has pushed up slightly. And we've actually sought to take some advantage of this by marginally increasing our overall duration of the fixed income element of our portfolios to around about 5 years. However, I do want to emphasize that we do remain more defensive in this area of the portfolios. And overall, we are exhibiting a lower duration equating to roughly 2/3 that of the benchmark. Yes, there have been some changes. We used the recent rally from April lows to move our portfolios to a more neutral stance when it comes to equities, whilst also retaining our broad defensive fixed income preference. We've mostly achieved this by reducing some of our equity positions, although the largest change has been to sell all of our positions in US small and mid-cap companies in favor of more defensive assets. We overall feel that there remain significant risks and there may be a lag as to the impact of tariffs, for example, the impact that they would have within the economic data that we see. And as such, we expect there to be a potential decline in that economic data from places in the US, such as the US over the summer months. If we were to see this decline, then we feel that US SMID is probably the most exposed element and therefore most at risk to a US-centric equity market pullback. As I just mentioned, we feel that risks have increased, but just as importantly, the risks have also expanded. Whilst the tariff threat remains very real, we are seeing increased meddling by the Trump administration in other areas of the US political and financial system. We're seeing increased threats to the Federal Reserve, to the judicial system, domestic foreign policies, as well as the emergence of proposed laws such as Trump's Big Beautiful Bill. And some of these may not be viewed positively by investors in both equities and fixed income, especially if the impact of some of these starts to be felt over the summer months. As such, as I just mentioned, we are more defensively positioned in US equities and debt than we were a few months ago. So at present, we are utilising alternative assets to provide our portfolios with protection and returns that are uncorrelated to both equity and bond markets. We essentially have two buckets. So the first one is a fund that tracks a hedge index that has provided average annualized returns in the region of 5.5% over the past 20 years or so in a very consistent manner. We also have a fund that is more geared towards providing protection if we see a sharp, sustained market correction. Yeah, we feel that the implementation of tariffs will almost certainly lead to increased inflation in the US in particular, although how extensive this impact will be does remain a little unclear. Elsewhere, the picture is more mixed. Falling energy prices may well benefit Europe and the UK, for example, as would potentially a redirection of trade goods away from the US. However, this might be offset by some requirements to absorb US tariffs by exporters, as well as an increase in the pricing of several raw materials. In short, we feel that we are likely entering a summer period of uncertainty. We remain unsure where several of the US administration's policies will actually land, and the impact of Trump's policies that have already been introduced have yet to translate through to the economic data. As such, as previously mentioned, we are more neutral on the US in particular. However, we do see some opportunities away from the US, particularly in unloved markets like the UK, which are sitting at substantial relative valuation discounts and actually exhibited a pretty strong degree of resilience in the recent market turmoil. So we've therefore maintained our overweight to these positions whilst balancing our more neutral stance to areas such as the US.